Welcome. Imagine watching $1.2 trillion completely vanish into thin air in just 180 minutes. That is exactly what just happened, and if you are managing your own portfolio, you cannot afford to ignore this. This isn't just an ordinary weekend market dip, it is a violent warning shot from institutional giants. A staggering $1.2 trillion evaporated from global equities in a mere 3 hours last Friday as frantic MSCI index rebalancing collided with sudden supply chain anxieties. This explosive liquidity shift blindsided over-leveraged traders, turning an ordinary weekend wrap-up into a violent warning shot for institutional portfolios worldwide. In this video, we are giving you the exact blueprint to navigate this chaos, tracking sector rotations, and identifying the 8 elite global stocks holding impenetrable moats right now. 2. Global market condition. Global equity markets entering June are trapped in a high-stakes tug of war. Breathtaking corporate AI earnings continue to push major indices toward fragile record highs. However, this optimism is heavily capped by escalating geopolitical blockades, uncomfortably stubborn energy inflation, and macro data revealing a clear slowdown in consumer services across major international hubs. 3. U.S. stock sectors performance. The 11 primary market sectors experienced highly divergent movements last week, driven by distinct macroeconomic and corporate catalysts. Information technology rose, as blowout server revenue sparked massive AI capital expenditure optimism. Consumer discretionary rose, on robust retail essential spending and margin expansions. Real estate rose, as hotel and office properties led broad gains. Financials fell, due to commercial credit deterioration and banking divestitures. Industrials rose, fueled by precautionary inventory stock building amid supply disruptions. Materials rose, supported by soaring global copper infrastructure demand. Utilities rose, on defensive positioning and power grid investments. Communications services rose, behind steady digital advertising and cloud resilience. Consumer staples unchanged, as lower-income cohort spending constraints balanced margins. Healthcare fell, pressured by surging medical service costs weighing down providers. Energy fell, on potential diplomatic openings regarding key oil waterways. Hit the subscribe button to be informed. 4. High-conviction expected movers. The following companies pass the strict Rule of 40 and possess 5 durable economic moats. United States. Broadcom Incorporated, AVGO. Custom AI SIC dominance accelerates exponential data center revenue expansion. Risk factor, supply constraints on advanced foundry packaging capacities. Crowdstrike Holdings Incorporated, CRWD, unrivaled platform switching costs drive exceptional subscription growth margins. Risk factor, aggressive pricing pressure from legacy firewall competitors. United Kingdom. AstraZeneca plc, AZN, deep oncology pipeline gives immense pricing power over peers. Risk factor, sudden regulatory delays within primary geographic markets. Shell plc, SHEL, dominant global LNG infrastructure captures massive structural energy arbitrage. Risk factor, volatile price swings within wholesale commodity benchmarks. Europe. Asml holding NV, Asml, absolute monopoly on UV lithography creates impenetrable market moat. Risk factor, tightening export restrictions targeting major Asian buyers. SAPSC, SAP, massive enterprise software switching costs fuel highly predictable recurring revenue. Risk factor, protracted cloud migration timelines delaying near-term margins. Japan. Tokyo Electron Limited, 8035, essential specialized chip-making tooling benefits from global factory build-outs. Risk factor, sharp capital expenditure pullbacks by hardware customers. Sony Group Corporation, 6758, entertainment intellectual property dominance secures steady multi-platform cash generation. Risk factor, softening global discretionary spending on premium electronics. 5. Regional conditions and trends. The U.S. market exhibits a stark divergence between AI-fueled megacaps and struggling small caps. Concurrently, Europe battles persistent industrial stagnation alongside weak consumer sentiment. In contrast, the United Kingdom faces heightened political uncertainty and lingering domestic services inflation, while Japan benefits from a structural corporate governance overhaul and favorable export tailwinds, drawing significant international fund inflows despite a volatile domestic currency. 6. Here at the stock market performance playlist is this week's stock terminology learner. What is the Rule of 40 and the 5 durable economic moats? The Rule of 40 dictates a healthy company's combined growth rate and profit margin should exceed 40%. The 5 economic moats guarding profitability are network effects, switching costs, intangible assets, cost advantages, and efficient scale. As of June 1, 2026, Microsoft, MSFT, perfectly stands as a dominant example combining both frameworks. 1. Financial performance, Rule of 40. Microsoft continuously clears the Rule of 40 bar by balancing massive cloud scale with hypergrowth. Driven by its widespread Azure AI infrastructure integrations, the company operates at an elite financial profile. Revenue growth, tilde 15% year-over-year. Operating margin, tilde 43%. Total score, 58%, comfortably clearing the 40% health threshold. 2. Structural protection, the 5 moats. Microsoft's business model leverages almost all 5 durable economic moats highlighted by Morningstar's qualitative framework, economic mode list, and reasoning. Switching costs. Migrating enterprise data off Azure or replacing core commercial Office 365 suites introduces crippling operational friction and downtime risks for businesses. Network effect. Platforms like Windows, LinkedIn, and the Xbox ecosystem scale in value as the pool of interconnected developers, professionals, and users grows. Intangible assets. Decades of global brand equity combined with massive proprietary AI patents and software copyrights legally box out competitors. Cost advantage. Microsoft owns and operates hyperscale data centers globally, allowing it to deliver raw computing and AI processing power at a fraction of the unit cost incurred by smaller tech rivals. Efficient scale. The massive capital barrier required to build globally competitive cloud data centers naturally limits the market to a few massive hyperscale providers. Leave in the comments what term you want defined in the next video. 7. Forthcoming week anticipated news. Market-focused center squarely on the upcoming U.S. non-farm payrolls and global manufacturing purchasing managers index (PMI) data. Investors will dissect these metrics to evaluate underlying economic resilience against building wage push inflation. Any signs of persistent labor market tightness will instantly solidify hawkish monetary policy expectations, while fresh updates on critical global trade shipping corridors will dictate near-term commodity and equity volatility. The reason understanding this specific liquidity shift is so critical is because it marks the definitive line where retail speculation ends and cold, institutional reality begins. Navigating June successfully requires moving away from speculative hype and anchoring your capital into resilient sectors and high-conviction, asset-heavy moats that can survive supply chain shocks and stubborn inflation. If you want to protect and grow your wealth when trillion-dollar shifts happen, you have to track where the smart money is migrating. 8. Call to action and disclaimer and poll question. If you found this data-driven breakdown valuable, hit that like button, subscribe to the channel, and share this video with a fellow investor. Let us know your strategy for this week in the comments below. Disclaimer: this video is for educational and informational purposes only and should not be considered financial advice. Always perform your own due diligence or consult with a licensed financial advisor before making any investment decisions. Drop a comment below or vote in the community polls. How are you adjusting your portfolio after the $1.2 trillion institutional liquidity shift? Thanks for watching. Stay disciplined, and I'll see you in the next video.
This is the stock market performance playlist, the sound of victory. Peace.